Okay, hello everyone. This is Kathy Lean with our ABCs of Forex Fundamentals Masterclass session. All of these sessions are recorded, and so if you're watching them on demand, you already know that they are recorded. But they will be recorded and posted onto a page for future viewing. So ABCs of Forex fundamentals. We're starting with the basics, and we're going to talk about, what it takes to truly understand the FX market. And this is probably the broadest session that we have. And if for those of you that may perhaps, have been trading for a little while or been in the markets for a little while, this session, a lot of this information, some of this information you will know already, but I promise you not all of the information you will know. So bear with me. There's a lot of good stuff that we've jam-packed into these masterclass webinars. Now, before I get too much into it, I'd like to share with you this disclaimer that says trading Forex carries a high level of risk and may not be suitable for all investors. So for those of you that are watching this video on demand, I highly encourage you to pause the screen, read through the disclaimer thoroughly before moving forward. So lots of really good stuff here. And to begin, I would like to start by just talking about the Forex market in general. The Forex market is the most dynamic market in the world in the sense that it's a market that truly responds to economic developments, political developments, and social developments. And I think we've seen a lot of evidence of that in the past couple of weeks, and are likely to see more of that in the next couple of years with different elections, and the next year with different elections and things like that. So what makes the Forex market so unique? First and foremost, the Forex market is open 24 hours a day, 5.5 days a week. So there's always a market available to trade. So you could trade, for example, if you live in Asia, you could go to work, come home, trade after you have dinner and spend some time with the kids. And that time, it would be the most active period in the Forex market, which is the U.S.-Europe overlap. So you can really fit your trading to your lifestyle and pick the sessions that you can. If you live in the U.S., for example, you could trade maybe during the morning before you go to work, or in the afternoon, or you can lay out some more swing trades. You can really customize your trading schedule. That's good and bad, of course, because having a 24-hour market means that there could really be a situation where there could be big moves overnight, making it essential for basically making it essential for you to use stops, because anything can happen overnight. Another unique advantage or another unique characteristic of the Forex market is leverage. There's a lot of leverage in our market. Leverage comes down in the U.S. to 50 to 1, but in some parts of the world, it's as high as 200, 300, 400 to 1. So leverage is truly a double-edged sword in the sense that there's a lot of impact that leverage has on price movement. I think in general, leverage creates a situation where it can compound your profits as well as compounding your losses. So taking a look at leverage, just so that I know many of you understand some of this basic stuff, but I promise you, as we get through this presentation, there'll be more things that you may find that you may not have known. But with leverage, let's say you trade cash and cash, and you start with $10,000. So if you're trading cash and cash, you start with $10,000. That means that a 100 pip move in the currency pair is about 120 dollar move in your P&L. So that's a 1.2% move. If you use 2 times leverage, which is common in stocks, then that 1% move 100-point move becomes a 2% move. If you use 20 times lever, which is less than what is a default in the U.S., that 100-pip move would be the equivalent of 24% of the required margin. And you can see how these numbers get compounded. So it's great if you're making money. It's obviously frustrating if you're not. Now, leverage is really key. Here at BK Forex, we've been trading for a very long time, and we have a lot of customers, and we always advise them to trade no more than 5 times lever. I know it's difficult to do because leverage is so tempting, but if you want to not only survive in this market, or if you want to first survive and then, more importantly, thrive in the Forex market, I do believe that it is essential to basically focus on using lower lever for this reason. So let's imagine you have a starting value of $10,000, and let's say you're in a situation where you're so unfortunate, and this will happen to all of us, that where you have 5 consecutive 1% losses. So you're so unfortunate that you have 5 consecutive 1% losses. So in this situation, if you are a no lever, you would only need to make back 5% in order to get your account to break even. And I think most of you will say, I think I can do that. I think I can get my account back up to 5%. On 10 times lever, on the other hand, that same 1% loss drops your equity from 10,000 down to drops your equity from 10,000 down to 5,900. So if it drops your equity from 10,000 to 5,900, that requires 70% to return your account to break even, which I think many of you may feel is much more difficult to achieve. And that's why leverage is so important, because it truly can make a big difference in your ability to not only survive but thrive in this market. And this is our table of doom that just kind of illustrates how difficult it may be to get back to your original equity depending on how much you've lost. So if you've lost 25%, you need to make back 33%, which I think some of you may feel, okay, I can do. But if you lost 75%, you would need to make back 400% in order to just get to break even, at which point you're probably trading very irresponsibly, very erratically, and very emotionally, which is not the right way to trade. Another unique aspect of the Forex market is liquidity. The FX market is flush with liquidity. So that means that there's a lot of participants, there's a lot of movements, and it's very difficult for any one person to manipulate the market, unlike in stocks, where there could be lower liquidity and you have these exaggerated moves, as it may be much easier for someone to manipulate the market. Unlike stocks, where there are so many different currencies, so many different instruments to trade, in FX, we really only focus on 8 major currency pairs and a couple of others. And we don't really even trade the couple others often. And they're basically the US dollar, euro, British pound, Japanese yen, Aussie, Kiwi, CAD, Swiss franc, peso, things that you're probably quite familiar with. At the end of the day, the bulk of trading is concentrated in the US dollar. 80% of all currency flow is with or against the US dollar, which is why the dollar is so important in our analysis, in our trading. And the reason for that is because in the FX market, it's not just about trading. There's a lot of cross-border transactions, M&A flows, import-exports, hedging, all of that. And since the U.S. is the leading trade partner for most countries, and the fact that commodities are oftentimes priced in dollars, that's the reason why the dollar is so important. So oftentimes when it comes to economic data, all that matters is really U.S. data. That doesn't happen all the time, but sometimes it will happen. PIP values range for a standard unit at $10 a pip if the dollar is the second currency in the pair. But some of the yen crosses, if it's the first currency in the pair, then it can have a fluctuating pip value. But I would say about between $7 and $10 is what the major currency pairs are worth. And so I talked about the first currency, second currency. Currencies are indeed traded in pairs. There's a base currency and a counter currency. The base currency is the first currency. The counter currency is the second currency. So in order for a currency pair to move, in the case of the euro dollar, either the euro has to go up and the dollar stays steady, or the euro goes down and the dollar stays steady, or the euro holds steady and the dollar goes up or down, or they both move simultaneously. And that's when you get the really exaggerated movements in the market. So we're kind of trying to analyze daily market flow. Oftentimes, you have to look, what's the theme of the day? Is it just pro-dollar, and the euro is just kind of flatlining and moving as a function of that? Or is it anti-euros, and the dollar is just a function, the euro dollar is just moving a function of anti-euro dollar flows? So that's very important. And then, lastly, rollover. Rollover is something that is also very unique to our markets, where with rollover, basically what you're looking at is you have the ability to earn. You either have the obligation to pay interest every single day, or you have the ability to earn interest every single day. And that's something that's very unique in my opinion, because it's something that creates a situation where you could earn some additional juice in your position. It also affects how currencies trade, because the whole idea of rollover affects whether people are biased to long Aussies or short euros or something like that. So now that we understand some of the mechanics, I think it's important to talk a little bit about the difference between trading Forex versus stocks. So on a big picture perspective, what moves stocks? On a day-to-day perspective, I would say that what moves stocks is generally one of these things: corporate news and earnings, economic data, interest rates, comments by central banks, which move the market in general, commodity prices, and market sentiment. So these are the things that generally move the stock market. So what moves the FX market? Pretty much the exact same things, with the exception of corporate news and earnings. So if we say with the exception of corporate news and earnings, then basically what you're looking at is economic data. The same things that move the stock market are the same things that move the FX market. So it's not too much of a stretch to be trading currencies. It may be the same things that you're watching every single day when you're trading equities. So when it comes to trading stocks, I think there's three ways to approach the trade. With stocks, you're basically trading the story, which I would say is valuation. Or you're trading the news, which basically pertains to corporate announcements. Or you're trading the charts, which is basically technical analysis. With currencies, trading the story means trading the economic outlook of a country, where interest rates are headed, things like that. Trading the news is trading day-to-day economic data. And the third way, you can trade the charts, because you in many ways you analyze stocks using the exact same tools, with the exception of volume, since we don't have volume in the FX market, as you analyze as currencies. Or you can use a combination of fundamental and technical analysis. Broadly speaking, as a rule of thumb, a good economy and a strong economy equals a stronger and higher currency. A weakening or weak economy will generally mean a lower value currency. So currency trading can, on the other hand, can be more volatile than stock trading, where each small move is incrementally larger in FX because of lever. Because if you think about it, currencies really do not move that much on a day-to-day basis, maybe 0.5%, 1% on a big day, 2% on 2 or 3% on a super, super big day, whereas stocks can swing, 5 to 10 to 15, maybe sometimes 20-something% in one day. That would be, a tectonic move in the FX market. So the only reason why people say FX is so risky is because of the whole notion of lever. And that's why, lever plays such a big role in market movements. With currencies, it's generally speaking, buy low, sell high, and you just have to be careful of whether it can stop you out before it rebounds. You want to look at practicing good risk reward. Well, I guess actually the point I want to make here is some of the things that you apply to stock trading may not be applicable in FX trading, because buy low, sell high, if you're just kind of range trading, you got to be careful of that, because sometimes currencies can trend very strongly. And because currencies can trend very strongly, they can really get ahead of themselves, and it can really lead to some exaggerated moves. So definitely something to pay attention to. It's in stock, we always generally are taught that 2-to-1 risk reward is the best way to go. But in our money management section, we'll share with you why it may not necessarily be the right way to go, because currencies also can be bounded instruments. And with stocks, usually people tell you avoid getting in and out of the market too often, but because spreads are so tight and there's so much opportunity that may not be applicable in currencies. So now let's get into an easy guide to understanding the global economy and how all of this works. So what is economics, and why should you care? Well, economics touches every part of our lives. I mean, from our jobs, what we decide to buy, how much saving and expenditures that we have. But yet, few of us truly understand how the economy works. There's several reasons for that. Some people are intimidated by the idea of economics, but I think the main reason is because most people think the subject is just too complicated. Some economists and analysts make economics, very difficult to understand, but in my opinion, it really isn't. And hopefully by the end of this session, you'll be much more comfortable with understanding how the global economy works and why it is so important. So why should you care? The answer is easy. Fundamentals are just as important as technicals when it comes to Forex trading, if not more so, because they will oftentimes determine the overall trend and direction of where currencies are going. A good example is the U.S. election. When Donald Trump was elected president, the market perceived that to be extremely positive for stocks and the economy and growth, and that led to a major move that just kind of overshadowed all technical things. And you just basically would have just bought every dip in the uptrend in the dollar. Now, there are two types of economics, macro and micro. And the only thing we care about is macroeconomics, because which focuses on the whole system or the economy, because micro, in the actual term micro, focuses primarily on individual economic entities like businesses and households. So how do we understand this? How do we get started? Well, let me ask you a question. How do you eat an elephant? Hopefully most of you have never eaten an elephant. I've never eaten an elephant, but the answer is one bite at a time. So the first step is to understand that the GDP is the economy. And the reason is because whenever people say the economy grew by 2%, for example, they mean that GDP rose by 2%. So, the Federal Reserve and central banks in general very much focus on growth. So that's why I think it's very important to understand the GDP formula and what goes into GDP. So the GDP formula has got these little symbols here, but C is consumer consumption, I is investment, corporate investment into new factories or trucks, G is government spending, and NE is net exports. So let's take a look at each of these things individually. Consumer spending is the backbone of most economies, and it's obviously affected by many things like population growth, income growth, unemployment, interest rates, taxes, but it is generally speaking the largest part of the GDP equation. That's why wages is such a market-moving indicator, like average hourly earnings. That's why retail sales is such an important indicator because it's such an important component of GDP. I pertains to investment. Investment is affected by many things. So when they want to boost growth, in order to boost investment, a central bank may lower interest rates, lower taxes, provide more ease of capital, basically. G is government spending. This is what investors are so excited about with a Trump victory, because he ran on a campaign of government spending, and a lot of it, spend, and they were excited that this would mean, sorry, they were excited, let me just clear my throat for a minute. They were really excited that the G component would really pick up and provide some much needed growth for the U.S. economy. NE is net exports, which basically pertains to trade. In the U.S., it's a drag, a minus to GDP because we don't really sell much abroad. We have a trade deficit. But in other countries, it's a contributor because, like, for example, Australia has a huge import-driven economy, especially in places like China. So, in summary, all of these things are what provides the engine of growth. And all of these things play a role in kind of anticipating growth going forward. Business cycles. Business cycles, expansions, and recessions. Every economy experiences cyclical growth. Peak to slow down to recession, trough to a recovery to growth to another peak. You hope that the path is generally upwards in that direction. So towards the end of 2016, most countries are still in the early stages of a recovery, far from peak levels. And so the hope is that the recovery would last longer before we actually get a peak. But it's important to realize that recessions are generally followed by recoveries and growth, and strong growth can oftentimes be followed by recessions. An expansion, so in terms of FX lingo, there's a lot of different language for this. Expansions can be called growth, upswings, recovery. Recessions could be called contractions, downturns, negative growths. And they're not all at the same pace, but it's something that is really important, because in expansions, for example, consumer businesses and government demand rise, but not necessarily at the same pace. We're at the top of this image. In a consumer-led expansion, demand rises more than than goods and services. So you have household demand rising, and when household demand rises, naturally businesses would turn around and increase production in order to meet that demand. When they increase that production, workers end up working more, and companies eventually hire, which is good for stocks and also good for currencies and risk appetite. It sets off this virtuous cycle of rising consumer demand, rising sales for businesses, and hopefully rising employment. So in a expansion, you do have this virtuous upward cycle where you go from consumers feeling confident in the economy to basically them willing to spend more, and then businesses willing to pay more, and then investors see the value of stocks rise, and with more money, investors buy even more stocks and more consumer goods, and the stock market rises overall. The opposite is Mr. Nasty recession. Recession is basically technically defined as 2 quarters of negative growth. So, in a recession, you get the complete opposite, which is a vicious and not a virtuous cycle. And it starts with consumers, businesses, and governments cutting back spending. When consumer demand declines, businesses cut back production, workers work less, companies lower wages, and they eventually fire, which is bad for stocks, currencies, and risk appetite, setting off this vicious and not downward spiral in an economy. And this kind of shows you how it leads in cycle, consumers not feeling confident, and companies laying off, unemployed workers have less money to spend, employed workers fear that they're going to lose their jobs, investors fear that the value of stocks will decrease, so they are less willing to invest in new companies, and then the stock market falls and the currency falls. So how are recessions fought? Recessions are basically fought in one of two ways, usually a combination. They're fought by the combination of fiscal and monetary policy. We had a lot of monetary policy after the global recession, and so we had a lot of monetary policy after the global recession, and the hope is that now, and the desire was that there needed to be more fiscal policy. So fiscal policy basically pertains to tax cuts, increased government spending, increased unemployment insurance. I have a picture here of Capitol Hill in the U.S., but this is true for every single economy because the central bank obviously has no influence on tax cuts as well as government spending. So this is not something that they can affect on a day-to-day basis. Monetary responses is what they can do. In the case of Fed, they could reduce the reserve ratio, cut the Fed funds rate, cut the discount rate, buy government bonds, weaken the currency. These are different ways for the central bank to affect, to impact the economy on a monetary basis. So I think it's important to understand what this really means because you may hear about it in the press, but you may not truly understand what all of this means. So we'll start off with cutting the Fed funds rate. So let's say we talk about cutting the Fed funds rate. So if you cut the Fed funds rate, what that ends up doing, or cutting interest rates in general, what that ends up doing is it lowers interest rates, frees up capital, and helps consumers. When you raise the Fed fund rate or the discount rate, what you're effectively doing is you're subtracting capital and you are hurting consumers. Just give me 1 second. Sorry, I just need to get out of one of my trades. So lowering rates frees up capital, helps consumers. Raising rates subtracts capital, hurts consumers. So that's the Fed funds rate. But what about the reserve ratio? Because actually some central banks do this often, and the Chinese are the most guilty of doing it. They're the ones who are most guilty of reducing reserve ratios. Why do they do this? The Federal Reserve does this sometimes too. Basically, reserve requirements is how much money is put into the financial system. And when you reduce the reserve requirement, you're basically saying to a bank that you don't need to hold so much money with the Federal Reserve, for example. So go out and lend it. Go out and spend it. And so they're basically putting more money into the financial systems because when they raise the reserve requirement ratio, they're saying that, instead of posting 10% of all your assets with the central bank, post 20%. I mean, these are very exaggerated numbers. They would never post 20% of the assets, but let's say 20%. So that means that they have less money to lend and less money to spend and invest, and as a result, they're taking money out of the financial system. Cutting the discount rate. Cutting the discount rate is similar to cutting the Fed funds rate. Discount rate is the rate the Fed charges on loans to banks. So banks obviously get a more preferred rate than we all do. So they basically it's the rate that they're basically charged to the bank, so they can cut the discount rates, which also can affect how much banks are willing to lend. So pop quiz: are lower rates positive or negative for an economy? I'm sure many of you know the answer already, which is that lower rates is positive for. Lower rates is negative for a currency, and higher rates is positive for a currency. But what kind of world of monetary responses are we in right now? We're in quantitative easing, LTRO, QE, LTRO, two phrases to become very familiar with. So, quantitative easing, which many central banks are engaged in right now, is basically the effect of buying government bonds. And with quantitative easing, the whole goal of buying government bonds is that when you buy government bonds, it ends up weakening the currency. Because, and I actually had this in a later slide, but I think it's important to bring it up right now, because bonds yields and bond prices are inversely correlated. So when a government comes out and they buy government bonds, it drives up the price of bonds and drives down the interest rate. And so by driving down the interest rates, the central bank is creating less motivation to buy the currency. So monetary responses are aimed at lowering interest rates and weakening the currency. What is quantitative easing? Well, if you break the words down, quantitative means a specific amount of money created. Easing means pressure on banks. And quantitative easing means basically buying financial assets from banks to flood them. So basically what you imagine is happening, the government is buying bonds. Who owns these bonds? Banks. So they're buying bonds. The banks own these bonds. And so what they're effectively doing is that they're putting money into the hands of the banks. So they're flooding them with cash. I mean, think about it. Think of it as the government putting money into the hands of, putting cash into the hands of these banks. And what's the goal? To get them to take that cash and lend. In Europe, we have a similar program called the Long-Term Refinancing Program, LTRO. So the Long-Term Refinancing Program, and let's talk about how it works. So how does the LTRO work? Basically, it's a similar way where the European Central Bank will lend to a bank like Santander at a much more favorable, lower interest rates, like 1%, for example. Santander then turns around and invests and lends out or invests that money at a higher yielding level. So let's say 5%, for example. So it's another way of putting money into these banks' hands with the goals of hoping to get them to lend. Where in the world do the central banks get this money? Do they really fire up the printing press and start basically printing this money in literal terms? No. What actually happens in quantitative easing is that it's all electronic. What they're doing is they're basically adding a couple of extra zeros into their bank accounts. So if Fed adds a few extra zeros into the bank account, they use that extra money that they suddenly created by adding a couple of extra zeros into their bank account to buy government bonds and other assets from financial firms. Firms use this money to lend or buy other assets like bonds, and as a result, bond yields fall and prices rise and the currency reacts. It's like, former Fed Chair Bernanke said, if we feed the banks enough dollars, something good is bound to come out of the other ends. But we all know now that there's a trade-off to quantitative easing and some of these ambitious programs. And these trade-offs are basically inflation. It's a trade-off between inflation as well as unemployment. And I think this is a very important trade-off because the whole deal with quantitative easing and LTRO is that inflation is very much is bad because it will hit struggling consumers really hard. I mean, just imagine prices just starting to rise for no particular reason. And once an inflationary spiral gets going, it's really hard to stop. And that's a serious concern for many central banks, the Federal Reserve in particular, which is why they feel like they want to get ahead of this whole inflation thing by raising interest rates, because they don't want it to get into an inflationary spiral. Inflation is viewed as a hidden tax on consumers, and it threatens to destabilize the financial system because it also makes it more difficult for the Fed to borrow. Now, of course, deflation can be toxic too. Deflation is basically defined as a period of falling prices. So deflation is just as toxic. And what deflation does is it's a situation where, initially deflation can be good because, consumers have low prices, but it only works if wages don't fall too. But many times in deflation scenarios, companies refuse to spend, and the lower prices hurts wages and hurts the economy in general. So how do we unwind QE? Because 2017 is a year about unwinding stimulus, hopefully. Some central banks are still enacting stimulus, but I think the next couple of years are about unwinding stimulus in general. So it's the reverse. The Fed subtracts a few, starts selling the government bonds and start unwinding this entire process. And so they start selling bonds. Well, I wouldn't say they sell. First, they stop buying less, or they buy less government bonds. Then they stop buying. And then they, in some cases, maybe start selling. And this whole process unwinds, where it ends up driving, on the bottom line here, when we do QE, it leads to bond yields falling, stocks prices rising, and the currency reacting. Unwinding QE means to sell the government bonds. The yields rise, interest rates start to rise, stocks start to fall, and the currency reacts. And that's why many people have predicted that when the Federal Reserve raises interest rates, that it would be negative for the stock market. The stocks would peak. But then you had the promise of fiscal stimulus from Donald Trump that kind of changed the picture a little bit. But that's something that we're watching quite closely. So we talk a lot about this, and I do believe that it's important to kind of recognize that in general, which is that bond prices and bond yields have inverse relationships. After Donald Trump was elected president, we had a massive sell-off in U.S. government bonds because foreign investors were nervous about holding U.S. assets. They were nervous about Trump, and so they drove bond prices lower across the board, and U.S. yields spiked dramatically. So this was a big story, and it played a very big role in the currency. It's a very important relationship to pay attention to, and probably one of the most important relationships, which is, as currency traders, we do watch bond yields very, very carefully, because we basically have the opportunity, if we watch bond yields carefully, they can give us a signal of where, of how the currency could trade, where it could be headed. So what bond yields and auctions tell us is that, sometimes currencies can also be sensitive to bond yields and auctions. And that's basically when we have a situation where the bond yields, let's say the bond auctions don't go well. So as a result, prices fall, there's higher yields, it's bad for struggling nations. So we pay a lot of close attention to the bid to cover ratio as well as the yields paid. The bottom line, though, to to taking all this information and applying it to currencies is that you want to put yourself into the shoes of the central bank. You want to figure out how to think like a central banker. And the way you do that is you think about this formula, which is you think about, how's consumption doing? What are the factors impacting consumption, investment, government spending, and trade? And that's the way you can think about what's the outlook for this. And that's the way you can think about, the potential impact. I think the potential impacts on currencies. So tying it all back to Forex, we're going to spend a lot of time talking about the 3 M's for Forex trading, but in a later webinar where we talk about what all this means for how Warren Buffett trades FX. But tying it all back to Forex, the way you want to look at it is you want to look at it from a big picture perspective. The 3 M's of Forex trading: macro, micro, monetary policy. Macro are the big stories: political conflicts, elections, risk appetite, how stocks are doing, what's happening in commodities. Micro, and that determines the bigger trend of a currency. Micro is basically the day-to-day data, like employment data, ISM data, retail sales data, inflation data, growth data. And then, of course, monetary policy. Monetary policy is very important. When it comes to monetary policy, it's important to know the players, know the mandates, and prepare properly. That's really essential to understand data. It's essential to basically assessing the market from a fundamental perspective. So now I want to get into some of the Forex fundamentals that I think are important to know that you may not know so much about, which is, first of all, fair values do not matter at all. Overvalued, undervalued is very applicable in stocks, but has absolutely no meaning in currencies, because currencies can be undervalued for very long periods of time. In the world of FX, the main way to measure valuation is through purchasing power parity. And as you can see in this chart of dollar yen, this is a 10-year chart of dollar yen. The white line across the chart is fair value. And you can see that we rarely hover near fair value. Dollar yen can be significantly undervalued, like it is right now, minus 20% undervalued, or significantly overvalued for years at a time. I mean, we've been undervalued in dollar yen, according to this chart, since mid-2012. So, and it didn't even try to gravitate back to proper valuation. So, purchasing power parity has absolutely, in my opinion, has absolutely no meaning or effect on it. But nonetheless, some people like to talk about it. So how is purchasing power parity measured? Well, it's measured by inflation. But once again, just because the Japanese yen is 20% undervalued means it has no meaning whatsoever. And same story with Kiwi dollar. Or it can be measured by the Economist's Big Mac Index, which also, they're completely different. I mean, look, the New Zealand dollar, according to Big Mac Index, is 23% undervalued, but it's 18% overvalued according to purchasing power parity using inflation. So don't care about overvalued over undervalued. Overbought, oversold can have an impact on currency trading, and we do look at that quite a bit. But overvalued, undervalued has absolutely no meaning. So just like China's currency can be undervalued for years at a time, it has absolutely no meaning. So the fundamentals that matter in FX that we talk about on a day-to-day basis include risk on, risk off. Risk on, risk off is extremely important because in many ways, the only thing that matters on certain days is whether the market is risk on or risk off. So it's really essential to understand what risk on, risk off means. So in order to understand what risk on, risk off means, you need to start by understanding what the two key phrases that are used in risk on, risk off: high beta currency and safe haven currency. Now, beta basically is a word that comes from the stock market, and beta refers to the assets volatility in relation to the volatility of the equity market. So basically, high beta means beta means volatility. High beta means extra volatility. A high beta currency is a currency that's extra sensitive or volatile to how the stock market performs. And stock market will oftentimes determine the quote-unquote general risk appetite of the markets. So markets go up. When stocks go up, high beta currencies perform better. When stocks go down, high beta currencies perform worse. Safe haven. Safe haven is basically a safe haven currency. To understand what a safe haven currency is, safe haven is a place to escape unpleasant or dangerous things. Safe haven currency is currencies that investors park their money in during uncertain and dangerous times. So when markets go up, people do not feel the need to park their money in safe haven currencies. So the safe haven currencies tend to weaken. When markets go down, they're selling off, investors feel the need to park their money in somewhere safer. And so that's when they look to safe haven currencies. So what type of environment is a risk-on environment? A risk-on environment is an environment where investors are optimistic, they're willing to take on risks, and that time you see money shifts from bonds to stocks, high beta currencies rally, and safe haven currencies sell off. In a risk-off environment, it's the complete opposite. Investors are nervous, they're pessimistic, they're shying away from all risky investments. At the time, money will generally shift from stocks to bonds. High beta currencies sell off and safe haven currencies rally. So then you may ask me, what are these currencies? Generally, risk-on currencies are the euro, the pound, Aussie, Kiwi, CAD, and risk-off currencies are the dollar, the yen, and the Swiss franc. So you take these categorizations and you apply it to what we just talked about. And this is all recorded, so I know there's a lot of information I provided to you, so you can kind of re-listen to it back and digest it at your own pace. And this is extremely, extremely important to understand because on any given day can really be a risk-on, risk-off mode, like this day here, where pretty much everything fell against the U.S. dollar except for the British pound because it was a pure risk-on day, and the dollar just rose against everything. And so on a day like this, it's very important to understand what is the dynamic of the market. And at the time, you can see it's just a broad-based dollar rally, such as this rally in the dollar index. So what determines risk-on, risk-off? What determines risk-on, risk-off is the 3 M's: macro, micro, and monetary policy. And as I said, in one of our future webinars, we will be talking about each of these in more finite detail. Another FX fundamentals that you need to know is what in the world is central bank intervention, and why is it so important? Central banks do not often step into the markets and intervene in the currency, but sometimes they will. And first of all, it's almost always an intervention to weaken the currency and not to strengthen it. Occasionally, it will be to strengthen it if the currency is excessively weak, but most of the time, it's an attempt to weaken the currency because central banks hate strong currencies because a lot of them depend on exports and things like that. So they rely very heavily on a weak currency. And two central banks that are very much sensitive to central bank intervention is the Japanese yen as well as the Swiss franc. So why do we care about central bank intervention? Because central bank, because the currency can kind of be range trading, on its way, doing its merry old thing, and then bam, all of a sudden you have central bank intervention in these huge moves. So instead of moving, maybe 50 or 100 pips within a given day, it will move 400, 500, 600, sometimes even 1,000 pips in one day. I mean, who can forget about the SMB intervention that we had in early 2015 that just kind of, actually they gave up the floor, but the previous intervention that they had kind of killed everyone. The BOJ, same story. On any given day, dollar yen may move 100 pips, but then suddenly, bam, you see that the central bank comes in, it'll move 400 or 500 pips on a given day. So very, very much impactful on the currency. And And that's why when you trade currencies that are at levels that are at risk of intervention, you need to make sure that you have stops in. But how does this intervention really work? Well, I mean, what effectively happens is first, the central bank, like policymakers from Bank of Japan, will call trading desks. They'll check rates, and they will ask the trading desk to buy the currency for them in the open market. And like I said earlier, almost always this intervention is to sell the currency and not to buy it because they generally like to weaken the currency unless it's, when the euro was first launched, it just fell aggressively, and they really wanted to shore up confidence, shore up support in this quote-unquote new project. So they came together with all these central banks to try to basically strengthen the value of the euro when it was first launched. Foreign exchange reserves. What in the world are foreign exchange reserves? This slide, foreign exchange reserves, still talks about intervention. So what they do is they call up the trading desk, and then they say, I want to sell yen, buy dollar. So buy dollar, yen. So they tap into the foreign exchange reserves, and they basically effectively sell the yen and buy dollars, and oftentimes parking them in U.S. treasuries. So there are two choices for a central bank when they intervene. They can sterilize the intervention, which means that they're selling the bonds domestically and soaking up the new cash, so it mitigates the monetary base effect. And the benefit of that is achieves psychologically, they say they intervenes, but practically the impact on the economy is less, or in the markets is less. Or they can leave the intervention unsterilized, where they basically sell the yen, buy the dollars, they park their money in. And that tends to have a greater impact on the currency. All right, so a couple more things. Just kind of, I know this is all over the place, but all very, very important to understand. Carry trades. What in the world is a carry trade, and how do they work? If you're trading currencies, you must know what a carry trade is. Carry trades involves borrowing or selling a financial instrument with a low interest rate and using that money to buy another one with a higher interest rate. This goes hand in hand with rollover. So how do carry trades work? So let's imagine we're in an environment where Australia offers 2.5% yield, Japan offers 0.1%. So the carry trade would basically involve buying Australian dollars, so basically selling Japanese yen, paying that 0.1%, taking the money that you've earned from selling the Japanese yen, and then buying Australian dollars at 2.5%. So you're holding the Australian dollar and earning that net interest rate differential. But in order for this to quote-unquote work as a trade for you, Aussie yen needs to either hold steady or rise in value. And for that to happen, and for carry trades to perform well, we need all of these three environments to be true. We need a low volatility environment. Investors need to be optimistic, willing to take on risk, and we need the central banks to have the central bank with the higher interest rate to have a bias to tighten monetary policy or raise interest rates. If any of these things are missing, you're not going to have an environment conducive to carry trading. Repatriation. Repatriation at the year end for countries can have impact how the currencies move, and they can have a significant impact on broad-based currency movements. And I think, with repatriation, it's just kind of a natural flow. So, for example, in the U.S., oftentimes we have window dressing at the end of the year. So there's a bias. So that means bringing money home. There's a bias for the market, for investors to buy dollars at the end of the year. So that's why you tend to have a bit of a rally because there's a bias to buy dollars. Same thing with Japan or the Japanese yen. In March, we tend to have the fiscal year end, so it tends to be a natural bias to buy the Japanese yen. The yen tends to have more of a seasonal effect to rise. Important correlations that you need to know. We will talk about all of these in further detail in our individual currency sessions, which will be coming up. But it's important to know from a broad perspective, currencies oftentimes will track equities based upon risk appetite. Commodities are priced in dollars, so how the U.S. dollar performs will affect commodity prices and hence commodity currencies. The dollar is king. It will oftentimes drive broad-based currency market flows. But correlations are not always causality, so just because they're in place doesn't mean that stocks will rise and currencies cannot fall. Other important things to know we'll touch is fixings. Some fixings, option expirations are both go hand in hand. So typically this is very set fixing times. And the main thing to know about fixings and option expirations is that fixings happen around 11 a.m. New York time or about 7:55 p.m. New York time. And currencies can oftentimes have unusual, unexplained movements during fixing times, because what will happen during that time is that a big exporter, for example, who's not sensitive to day-to-day currency rates, will say to the bank, "Oh, just sell me 100 million euros," and they need a reference point, and the quote-unquote official reference point is the whatever is posted by these like Reuters, for example, and they usually do it at a very fixed time. So the bank will try to implement the trade as close to the fixing time as possible. So usually around that time you have a very unexplained action. Option expirations are similar. So option expirations have a specific time, like 10 a.m. cut in New York, or sometimes the 12 o'clock cut in Europe. And currencies can oftentimes see very unusual movements around option expiration. I mean, just think about it. Let's say you're a bank and you've sold, your Goldman Sachs, you've sold a hedge fund, 100 million $110 yen option, no touch dollar yen option. So basically the whole idea here with the payout of, let's say, $20 million. So the idea is that, if dollar yen touches, if the dollar yen doesn't touch 110 before 10 a.m. or 12 o'clock, you don't have to pay the hedge fund money since it's a no-touch option. If it does breach 110, then you have to pay the hedge fund. So the bank will be doing everything in their power to prevent 110 from being touched. The hedge fund will do everything in their power to get it to touch. And so as a result, you have a lot of two-way action, and you have a lot of cross flows that could be counteractive. And once the cut is over, though, you may have like a very smooth movement in price as the real market forces take over. The last thing I want to leave you with is a definition between real money and smart money, also a phrase that we follow quite closely. Real money basically refers to exporters. So when they say real money is buying, that these people usually aren't directional. Smart money pertains to funds, hedge funds, institutional investors. Usually their buying is much more directional. So that's a lot of information that I've given you. And as I said, this is all recorded, so feel free to kind of run through it at your own time, re-listen to it, and you can always send me questions at Kathy@bkforex.com.